Thank you very much, Jan, for the introduction. And I would like also to thank all the participants for taking the time to join the conversation today. I must say that Alicia and I are thrilled about the opportunity of exchanging our views with the ESSEC community today. And by the way, let me reassure you right now, I'm definitely not the main force here. Alicia is the real thing. And I would like actually here to extend my thank you to Alicia, who has kindly accepted the invitation, especially now that during her leave in Europe. So thank you very much, Alicia. But anyway, before we dig into the subject of the day, and because this is an ESSEC webinar for ESSEC alumni, I wanted to say a few words about my personal relationship with the school. And I came to the office a bit earlier today in order to prepare for this webinar. And through the process, I realized that actually I graduated from the school more than 15 years ago, which may sound like Stone Age for some of you. And then I look back at those 15 years and I was very amazed by the influence that ESSEC had on my life, both professionally and personally. And I don't say that only because I'm married to an ESSEC alumni. No, I'm sincerely very grateful for the inspiration, the opportunities, and the relationships developed through the network of the school over time. And this not only in France, but also in Hong Kong and Singapore, where the ESSEC community is really fantastic. It's accessible and it's so friendly. Now, remembering my days at the school, actually, I would have never imagined myself holding a CFO position one day. Let me be very honest here. And actually at that time, accounting classes were, let's say, not my preferred classes, but I was very wrong, obviously, right? And looking at this memory actually reminds me of a specific day in class when a student, believe it or not, actually fell asleep during that class. And that was so embarrassing, as you can imagine. And at some point, the professor asked the student sitting next to the sleeper to wake him up. And there was a long silence. And then the awake student responded to the teacher and he said, "You put him to sleep, you wake him up." And I love this story because it also reminds me that I only have that small amount of time before I lose you, before I lose your attention. And so I suggest we give it a start. And why have we selected this topic of the day? Well, the context is that China now accounts for more than 15% of global GDP, right? This is up from less than 4% 20 years ago. The economy of China is now the second largest, and it can be first depending on how you look at it. It is playing a strategic role in the global trade. However, when you look at the overall weight of China in the financial system, it's still relatively limited. But as you will see in the course of the presentation, Chinese banks have grown to become huge. Their total assets now overpass those of American and European banks. They are providing more cross-border credit, which actually used to be the strength of international banks. And more surprisingly, they're also gaining market share in sophisticated capital markets kind of products. So with Alicia, today we will share our analysis of the Chinese banks. The first part of the presentation will actually focus on the drivers that pushed banks to become so big, so large. And the second part will actually explore more the key trends. And we will discuss the opportunities and the challenges for European players. So with that, Alicia, I will hand the mic over to you.
Thank you, Eran. It's a pleasure to be here. I wish I were an alumni of ESSEC, but I'm not. I'm here to basically share this conversation with Eran. We are even sharing the presentation half-half. This is the way we work at NATIXIS. It's a lot of teamwork. And we've really enjoyed the preparation of this presentation. We've both learned from each other. I'm going to focus on what I call the boring part. I'm going to bore you with a lot of details, as you know, a lot of nitty-gritty of where Chinese banks stand. But I'm going to do this because in order to get to the interesting part, Eran will be covering on where are they heading? I mean, are they a risk for European banks? Not sure we're going to answer that question, by the way, but you know, you will get a hint at it. But most importantly, to even know whether there is major risk, financial stability risk, or whether this is an opportunity for European banks to you know, head towards China, given that China is opening up. I need to bore you a little bit, because we want to do this on the basis of relatively, if I may say so, sound knowledge. You know, not just, you know, FT type articles. We want to show you lots of figures which you can then use to put these things into context. How risky, how big is the Chinese banking sector? How risky? And thus, how to approach the question, where are they heading? Is it a risk for everybody else in Europe? Should we head there? Are there financial stability risks? So that's what we are doing here, so that you bear with us for a second. And I'm going to start by sharing the presentation, which you can surely have a copy of later. I'm sure that can be done. And I'm going to start by looking at the following question: why banks are more important than ever in China for growth? And the answer is pretty simple. They've always been important for growth. But as they grow faster, believe it or not, Chinese banks, bank assets have been growing much faster than China's GDP, much, much faster. So in other words, although we may have this idea, right idea actually, that China's financial sector is modernizing, which it is, and you know, becoming, and Eran will have a word on that, more of a Western type, you know, with securitization and so on. I have to remind you though that these banks are bigger and bigger asset-wise, old-fashioned way, as we would say at NATIXIS. You know, it's not a asset-light strategy, let me tell you. And I'm going to show you that, and that's very important for the world, because we tend to forget this irony. Eran just already mentioned it. We tend to believe that the you know, like China is a big, gigantic economy with a small financial sector. This is wrong. It's a huge financial sector, even considering China's humongous size economically. And that's the first thing I want to really show you. So if you give me a second, I'll move to the following slide, which is bank assets. So China's bank assets are 42 trillion US dollar. So basically very close to Europe already, 63 to 42. Europe's assets have actually increased quite dramatically since 2008. That's why, you know, China has not coped with that increase. But remember, this masks the reality that still today, Europe as a whole, and this includes the UK, GDP is bigger than that of China. We always talk about the US, but actually Europe's GDP is bigger than China, I remind you. Now, our income per capita is also higher. I don't know for how long, maybe for many years, but still higher. So if you do this very interesting financial deepening story that you probably have learned at ESSEC, which is that a country's financial asset size should relate to its GDP per capita. Yeah, you can imagine how big this financial sector, China, is going to become once the GDP continues to grow. And that's what we want to show you in that slide. So it won't be 42 trillion, not even 63 like Europe. It might be 200 trillion. If you just simply think of China's income per capita in, say, 10 years. So what are we going to do in the world with a financial sector that is 100 or 200 trillion? What are we going to do? That is really the question we want to pose ourselves. Now, as it so happens, though, this financial sector, or I'm focusing on banks now, of $42 trillion is very useful for China. Why? Because China needs to grow now more than ever. COVID-19 is having a toll on China, and it's having a toll on everybody else. So these banks will be put to work. Okay, I want to clarify this now. I want to give this external story. We want to focus a little bit on the external story, but the first thing I want to say is that China's banking sector, 42 trillion, is mostly concentrated in China. We know that. But increasingly, there's about $1 trillion, a trillion out of 42 abroad. This is China's cross-border lending. I say about because nobody knows. And nobody knows because, for a number of reasons, China does not yet report to the BIS in terms of a lender. Here, I can only guess a little part of it, which is international claims, BIS international claims, but I can't really know where it's heading. We don't have that information. And it looks small compared to Europe and compared to total international claims, but this figure might be underestimated. The reason is that a lot goes through Hong Kong. And that's what I'm showing you on the right, which is the market share of Chinese banks in Hong Kong, which has increased dramatically. And then from Hong Kong, Chinese banks are going abroad. This is partially true for Singapore, but much less than for Hong Kong. So I'm just saying, out of the 42 trillion, remember, a lot is going overseas. Eran will then tell us whether this is bound to continue or not. But I wanted to tell you that not everything we see is just stimulus. It's partially a cross-border lending, which is very important geopolitically as well for China. Now, going back to what's happening with the stimulus now, so after some deleverage happening in 2018, especially financial deleverage, China has come back, China's leadership has come back to using, if I may use that word, banks to grow, meaning bank assets are back to a much faster growth pattern. And this is particularly true, I mean, not particularly, but given what was happening in 2018, it is particularly true for smaller banks, which had suffered that deleverage more than larger banks because they were considered to be more at risk. I focus on smaller banks because you will see in a minute in the story that they are the riskier. So the fact that they're coming along with stimulus to lend, you may say, is kind of counterintuitive because we've heard so much about the leverage in China. It isn't. And the reason is simple, because those smaller banks are the ones lending to the smaller companies, SMEs, microcredit, etc. So they're more needed than ever. And I'm sure you followed, if you're in the market, the PBOC's recent announcement early this week about kind of an asset-backed security type instrument for 100 billion renminbi, which is exactly there to buy temporarily for a year small company loans, mainly from small banks, yeah, to allow them to lend more to this specific sector. Why is China doing this? Because not only does China need stimulus, but it needs to keep those small companies afloat. Why? Because that's where the employment really is. And that's what China really needs to do, more than growth, keep employment. We learned this from the 2 sessions. So very quickly, banks are important in China for one more reason, is that even if we hear a lot about this humongous growth in bond issuance in China, especially onshore, but banks hold the key to this market because they hold about 2/3 of these bonds in their portfolio. So you have to realize that without banks' health, financial health, this bond issuance would be hard to keep unless you would move to a more, of course, kind of Western type model of bond market infrastructure, which China doesn't have yet. So banks are important for this reason as well. So the fiscal stimulus, local governments, which is mainly through local bond issuance, local government bond issuance, also depends on the bank's financial health, if I may say so. So very, very important for China. And this is why, as you can see, the PBOC is helping them through, lowering the cost of funding, and thus helping banks lower the cost of funding for companies as well. This very detailed thing is only to show you, because many people ask me this question: is shadow banking back? Will China rely on shadow banking for its stimulus? And the answer is yes, it is back in a different form, but it is back. You can see there that total bank assets, what we call non-bank financial institutions, which is basically off balance sheet, many of which, by the way, is banks themselves, have to tell you. It's just that it's a non-consolidated part of their balance sheet, is growing much faster, as you can tell on page 9, than any other type of bank assets. So this is what I want to show you. Yes, it is back in a different form. Now, with the stimulus that the leadership expects from banks, and this is very clear, there is a carrot, and stick approach. The leadership expects banks to lend, helps them lending through these programs that I just mentioned from the PBOC. There was also, before the COVID-19, there were such programs. Think about perpetual bonds being issued with the help of the PBOC through a swap line. We could talk for hours about this, and I don't want to steal Eran's time. I just want to say that this stick and carrot approach, although more convenient than just a stick approach, is still worrisome for banks. And that's what I want to hint at, because the asset growth expected, so bank lending expected, and you can see that it is indeed increasing in 2020, comes at the cost of profitability for banks. Chinese banks have a profitability issue. And you can see that from the profit announcements of the first quarter of the year very clearly. Why? Because not enough provisioning there compared to the West. Why? Because they don't want to harm their profitability even further. So we need to be very clear here. I'm not talking about a crisis or anything like that, but it is obvious that they're making an effort, and that profitability is coming down and will continue to come down. And on top of that, beyond of course, the NPLs and the provisioning policies, we need to realize that the net interest margin is coming down. And this is very important for anybody operating in China, because interest rates will no longer be what they used to be. They're heading downwards, and that's going to hurt, as we European banks know very well, Chinese banks' profitability very clearly. They have tried to lower the cost-to-income ratio, which you see has remained relatively stable, but coming down in 2020. But it's just not possible, in other words, just to accommodate this net interest margin reduction just by cutting costs, because it comes to a point where there's no more to cut. Last thing I wanted to show you is the loan provisioning. This is tricky because, unfortunately, NPL ratios in China are, I don't want to say distorted in a negative sense. It's just that the definition of NPL is very subjective. So it's really hard to see that in a ratio. But I do want to tell you that there is an effort that Chinese banks are doing, partially covered by perpetuals, as I mentioned, to increase capital, knowing what's coming, and to keep that loan, that coverage ratio at bay. Capital is an issue only for smaller banks. They have improved lately, as I mentioned, but it's still probably not enough for what's coming in terms of stimulus. Do we have a real asset quality problem in China? And I finish here. I think we do for smaller banks. If you look at the NPL ratios I mentioned before, you don't really see it very clearly, but we all have to remember that China has a different definition of NPL, wider definition called special mention loans, which are less, their provisioning is much smaller. And when you add the two, you're coming close to something of 5% of total loans as trouble loans. that's a lot to cover, and Eran is the expert in this. So I will leave it here, give the floor to Eran. In a nutshell, banks are so big in China. Bank assets are huge. They're put to a good use, stimulus, but there are risks involved in this strategy. Thank you, Eran. Floor is yours. I'm going to stop sharing.
Thank you very much, Alicia. Wow, I'm impressed by how clear you have been, and now the pressure is on me to try to be up to your standards. I will now share more or less. I mean, it's the same document, but just I will take over it in order to go through my part, which is starting on slide. It's loading. Sorry, it's a bit slow. But these are the slides that Alicia just presented. And I am starting here. So the question is now to look at the future, right? Which is not the easiest part. And if we move into the first slide, what do we see? Well, we see that Chinese banks actually have a lot on their plates at the moment. And I think Alicia clearly explained all the challenges that are coming into play for Chinese players. First, they are being asked to support the economy, right? More specifically, they are encouraged to lend to private and small firms, which by nature is riskier than lending to large state-owned enterprises. This domestic pressure is slowing their overseas expansion with less investments abroad, and we'll come back also to that. At the same time, Chinese banks are transforming their internal capabilities in order to be able to use more complex financial tools. And this is my next slide. I'll come back into that as well. Those challenges, they also come at a time where China is gradually opening its financial market. One, the ceilings have been basically lifted for foreign ownership to be authorized for funds, for life insurance, for securities, for banks. So in theory, this could increase the competition coming from foreign banks onshore. Two, China is offering new channels for foreigners to invest into Chinese stocks or bonds, mostly via Hong Kong, by the way. Three, China is now increasingly included into global indexes, which is encouraging, in a way, large investors to rebalance their portfolio with a growing exposure on China. So here, what we can say is that while Chinese banks are halfway from the cleanup that they're still in the process of doing since the financial crisis of 2007, 2008, well, the situation is becoming more complex for them. Now, if I move to this page, which is very interesting because it shows how Chinese banks have been catching up with Western banks with new capabilities developed on securitization. So for those of you who are not familiar with this process, well, securitization is just a mechanism that consists into packaging a set of loans, mortgages, consumer credits, and sell it to non-banks, households, or the likes, okay? So if you look at the bar chart on the left, you can see that the volume of asset-backed securities has evolved from almost zero in 2013 to 3.5 trillion RMB last year. And most impressively, this amount is equivalent to almost 1/3 of the total stock of mortgages granted by Chinese banks. So that's huge. And securitization is definitely becoming an important means for Chinese banks to divest a part of their assets to non-bank financial and household. Now, if I take you to the next slide, this one focuses on smaller firms. And if you look at the graph on the left, what you can see indeed is that the loans to SMEs, right, are growing again since 2019. And the bar chart on the right highlights that the growth is even bigger for large banks. So This hard target and the regulatory push from the central banks on domestic banks is driving the increase of loans towards smaller firms. So this is, by the way, a good way to support the economy, but it comes with potential challenges for the banks. Now, well, this page here is looking at the overseas exposures and ambitions of Chinese banks. Just let's take a step back. Since 2015, the share of Chinese banks into the global cross-border lending has risen from 5 to 7%. The foreign assets in the books of Chinese banks now account for 9%. But what I find even more interesting beyond the figures is that the international development, presence, strategy of Chinese banks is pretty different compared to the one of American and European peers. Why? Well, Chinese banks have actually been more focusing on emerging markets, where they supply today a big chunk of the cross-border lending. So the one case in point is the Belt and Road Initiative, right? Has been launched under the leadership of the President Xi Jinping, has been a strong accelerator of the overseas expansion of Chinese banks. And next to that, of course, Chinese banks are also growing with their champions, okay? And when you look at the big Chinese corporates, by the way, now a quarter of the Fortune 500 list is composed of Chinese names. So they are growing, and they are growing also international. And so the banks are accompanying them with trade finance, cash management, and FX services. And here again, I must say that when you look at where is their international development, the focus remains largely, not only, but largely in Asia and other emerging markets. Now, if we look at how it translates into the balance sheet of the Chinese banks, and if we look at recent trends, if you look at the graph on the right, basically the data actually shows that the foreign assets that are held by Chinese banks have sharply declined in 2019. So this trend suggests indeed that all the ongoing restructuring of the Chinese banks and the requirements to continuously support the Chinese economy in this very difficult time will probably push them to slow down or to retrench from some cross-border operations. One word on foreign investments. So basically, while the Chinese banks are slowing down their international ambitions, what we observe is that foreigners are owning more and more assets in China. As you can see on the graph on the left, the foreign ownerships remains low. I mean, 3% of the total bonds and equities. But what is striking is that this has tripled over the past 4 years. And a part of these investments are actually channeled via the Hong Kong Stock Connect that was created in 2014. And this now accounts for 8% of the shares trading in Hong Kong. Another thing to note, if you look at the right side of the slide, is that foreign investors are playing safe, at least for now. And they're focusing mainly on treasury papers. But what it's interesting to note that foreign investors are increasing, let's say, their allocation to China's onshore assets. So this trend is happening. I must say it's happening slowly, safely, but it is happening surely. Okay, so with that in mind, the question is, what opportunities for foreign players in China? And maybe we'll have more time to discuss that after the conclusion. China is opening its financial markets, okay? But Chinese banks still hold 98% of the domestic share. Let's be clear, China is their turf, okay? And by the way, what do we mean when we say that China is opening up? Let's maybe clarify that. Well, last year, the Chinese regulators have authorized foreigners to have full ownership of local banks, wealth management firms, pension fund managers and brokers. And more recently, they also allowed ownership of securities firms. And another important opening to foreign players is the domestic bond market, which is huge. And it captures actually more than half of the bonds issued by emerging economies. So with that context, as you can see on the left, the first foreign institutions that entered into China via the minority joint venture scheme were the asset managers. I mean, those JV hold an impressive 40% share of the asset management fund market. It's much, much more, as you can see, than what we observe for life insurance companies, for securities houses, as well as for banks. So clearly the opening and the liberalization is super attractive to foreign players, but it won't be easy, and it will probably take time to actually catch up with the network, the knowledge, the relationships of domestic players. Now, what lessons can we already learn, if any, right, from those foreign banks who dared to invest in China in the recent past? Well, at a pure profitability standpoint, and there are many other parameters, right? From a pure profitability standpoint, when you look at the graph on the right of the slide, it shows that foreign banks, well, do have a higher cost-income ratio, right? And a lower return on asset than their Chinese peers. So if I go back to what Alicia said a few minutes ago, the profitability of Chinese banks is slowing down, and the profitability so far of foreign banks with domestic presence is even lower than the one of their Chinese peers. So in a nutshell, it's difficult, right? And what we can say is that for sure new opportunities could emerge from this opening, especially for lifers, for securities, but we feel it will take time, and the challenge remains on how China will ensure a good level playing field for all players. I think this is the last slide we have before the conclusion. Alicia, can I hand it over to you to wrap up, and I will also provide a few words to conclude.
Thank you, Eran. Thanks very much for the enlightening presentation. I'm going to wrap up very, very quickly. Basically, just by reminding the audience that the points we want to make here is that although we always talk about the huge size of the Chinese economy, we tend to forget how important, how huge, how important banks are for China. And because they are huge, how important they are for the world. And we can't talk about global financial stability or instability without thinking about Chinese banks and what they really imply. And Chinese banks are not only banks, they're also major holders of Chinese bonds, which is one of the largest markets in the world. So now, should we worry? And my take in this presentation is that we shouldn't necessarily worry too much. First of all, because although they're huge, still their share in terms of cross-border loans, which I remind you, I mentioned about $1 trillion, which is again the best estimate we have around, is still moderate. There's capital controls in China, so yes, it is very important, but it could become even more if those capital controls were to be lifted, which we don't expect to be. There could be indirect channels for these banks to have massive implications, but I think the whole point here is perhaps the most important immediate implication is China's stimulus and how these banks are going to grow even faster out of that stimulus. and what is it in for us as foreign investors in China or in the world. So on that note, I think I just want to wrap up by saying, as Eran mentioned, we know that this is a transforming banking sector, that there's lots of issues that we need to focus on, and that opening up that refers to us directly is of course a huge opportunity, but also comes with risks given what's happening and that transformation. So I leave it here, pass on the word to Eran for final conclusions. Thank you.
Thank you, Alicia, and obviously I share fully your view. Will there be opportunities for European banks in China? The answer is a big yes. Will those opportunities be easy to capture? Of course not. China is a challenging market, and I'm sure most of you here connected today who are interacting with China knows that, right? So China is a challenging market because, especially in the banking industry, but not only, it has lots and lots of regulations and licenses to comply with. But China is too big to ignore. And the key for European banks is to define their strategic positioning. You know, where do they want to play? Where do they want to compete? What value do they want to bring? How can they differentiate themselves with new ideas, innovative content, or exclusive services? In China, I would like also to say, and that's maybe a bit more specific to China than to other countries, partnerships are crucial, right? They are crucial to complement basically the strengths of the local players who could know the market with the strengths of a foreign player who could bring the expertise. So going hand in hand in China can be very impactful. The growing inclusion of Chinese securities into global indices, we've touched about that a little bit during the presentation, will also drive foreign inflow and opportunities, especially, but not only via the Hong Kong Stock and Bond Connect. Likewise, well, the share of international stocks and bonds in Chinese portfolio is super low, actually. They're very domestic invested. So the opening of China financial industry should allow savings to be better allocated with a growing share of international securities, right? So whatever that means for international banks, I think there would be, of course, opportunities to capture in that space. But what I truly believe is that there will be no shortcut. There will be no fast track for foreign players. Access to Chinese market requires patience, for sure, agility, and long-term commitment. I definitely find this topic fascinating. I think we could, as mentioned by Alicia, spend hours digging further on the matter. I really encourage you to look at NATIXIS research website if you're willing to get more insight on the topic. I also recommend you, for those who are interested specifically on international banking in China, to buy the edition of May 9th of The Economist, because there was a very interesting special report which inspires some of the thoughts I've been sharing with you today. Now, if you allow me, I would like to conclude also on a different and more personal note. I told you earlier, 15 years ago, I was at ESSEC, and I remember one of my professors at ESSEC told me that success would not be about how much money I would be making, but it would be about the difference I would make in other people's life. I must admit that 15 years ago, this advice did not resonate that much, as much as it does today. Let's put it this way. Clearly, the world we are living in today is being dangerously stretched. The past few years have seen the rise of populism movements, social unrest, racism, violences, inequalities, deglobalizations, and tensions between the two superpowers. Now, COVID-19 has hit the world at a very challenging time, probably accelerating some of those trends. And climate change is here, hanging above our heads like the sword of Damocles. I've been lucky to benefit from the best of a borderless world. And I know, Alicia, we share that together. I was born in the Middle East. I grew up in Europe. I studied in the US, and I'm now very proud to work in this part of the world. I believe in the virtues of connecting people across borders, across cultures, and I would love my kids to enjoy similar opportunities. And my hope is that at some point, reason will prevail with peaceful coexistence of those two superpowers. But we all know that hoping is not enough. So I would like to go back to this advice that my professor gave me 15 years ago. And I think that each of us can make a small difference and have an impact at our level in both our personal life and our professional life. And as far as banks are concerned, because this was the topic of the day, I would like to say that the banks shall continue to play a strategic role in 1, support the real economy, 2, create bridges across continents, and 3, more importantly, banks should promote relentlessly sustainable investments across the globe. So with that, if we have some time, Alicia and I would be delighted to take some questions. Thank you.
Thank you for the presentation, Eran and Alicia. Now, we do actually have some questions from our participants as well. I'll start off with the first question. China's digital currency is taking shape, and how do you think it will impact the world from your view?
Okay. Maybe I shall start, leave the floor to Eran just for him to breathe a little bit after these very emotional words that I can't share more, as he knows very well. I feel exactly the same, and it's quite worrisome what we're seeing. But I'm going to focus on the question. That's why people connected, so they deserve an answer. I don't have the best answer on earth, but I've been working on this topic for a while in my whole life at the BIS. This is many years ago. We were already discussing digital currencies, and I'm telling you, blockchain was not yet somehow a full reality, but the idea of digital currencies has been in the minds of economists for a very long time, perhaps in a different shape. But interestingly, the idea of digital currencies, which I think is very much coming to where we're heading for China, was all about international signage, meaning how central banks could challenge what we could call the extraction, if I may say, of seigniorage by the Fed all over the world. So just to give you a sense, 2/3 of dollar banknotes circulate outside of the US. Just because seigniorage today is not very relevant because interest rates are very low. For seigniorage to be important for a central bank, you need to go back to that time where I was analyzing the topic. Interest rates were positive in real terms, and maybe nominally something around 3 to 4. So seigniorage was a big chunk of money for central banks to make. Today it's not about seigniorage, but it's still about having an international currency. I do think China, and this is my humble opinion, is pushing for an e-renminbi. There's no name for this currency yet, but because it wants to provide an alternative to the dollar. And there was another question I was eyeing on Hong Kong. So, you can imagine if you have sanctions over your head, yeah, I'm sure you are longing for for holding an international currency. The euro might not be an answer because, how is the euro going to detach from the dollar in the sense that how is the Eurozone going to avoid pressure on sanctions? I'm putting myself in the worst scenario, but so that we understand and aware of how long-term the Chinese leadership thinks, how important an international currency may be. So how can you hold an international currency with capital controls? It's impossible, except except with a central distributed ledger, because that means you know where the money is going. So this is like, you know, like square in the circle, or for China, think about it. I mean, you can have an international currency while controlling it. The whole nature of an international currency is you can't control your monetary supply, because 2/3 of your banknotes, let alone your deposits, are somewhere else you can't control. But if you manage to run an e-currency but this is the trick, it's not so easy. People need to believe this currency, e-currency or not e-currency, nobody cares, is stable. So for me, the key question here is, can China hold an e-currency that becomes a reserve currency? Only if they prove the renminbi can be stable. Yeah. That's the key for an international currency. It's not only about the size of the economy, I'm sorry to say. And that is what we need to demonstrate. Now, the recent move on the renminbi as a consequence of what was happening in Hong Kong is very telling, meaning, I mean, it's hard to hold your currency stable. And by the way, the whole idea is that you do not hold it stable, it's the market holds it stable. So I hope I have answered, meaning, yes, you can do it, but there's a part of it you can't control, even if it's an e-currency. At least when, you know, the volume of that e-currency becomes relevant. So can China do this? It is very difficult. It's not only about, you know, knowing who is doing the transactions that makes you hold an international currency. That would be my answer.
Okay, I mean, I can't agree more, but let me just add a few extra comments to that. I mean, yes, for sure, for the renminbi to become a global currency, I think probably one of the biggest challenge will be to manage the strict capital control that we see today. That's one element. Now, I'd like to share a story. Right, 5 years ago or so, I went to meet my teams in China, and we were at the restaurant. And at the end of it, we wanted to share, the bill, and my colleagues took their phone out and they started to use, the WeChat and so payment apps, which at that time we didn't even have Apple Pay and so on. The reason I'm sharing this story is that China is definitely leading innovation on payments, and I think expanding their technology for cross-border usage can be a smart way for them to actually promote digital currency, whatever it is named in the future. And I think that can be a good way to accelerate for them the usage of this digital currency. And actually, it could be a smart way also for them to bypass this huge ecosystem that has been built by the US through the USD clearing, but also the Visa, the MasterCard, the SWIFT systems. So that can become a huge opportunity indeed. So very good question. The answer is very difficult, but I think there are definitely interesting things that are going to happen there.
The next question that we have is, how can we explain that foreign banks' cost-to-income ratio in China is so low compared to Chinese banks?
I need to clarify, it's actually double. Maybe there was some misunderstanding. It's 66 compared to 32 in the slide that Eran showed. So the whole idea is that cost to income is double, return on assets is half. So partially because cost to income is so high. Why is it so high? Because, foreign banks need to pay more for services of any kind, including talent. And most importantly, there is a lot of associated costs. Eran can give you more detail because we operate in China. But that's the general rule. It's actually double.
Well, yes, it's a scale issue, right? You as a foreigner, you arrive, you have to comply with the minimum requirements, which then you need to monetize. And of course, when you're a big player, you've been there for a much longer time, and so by construction, almost you can have a better profitability. So that's why I'm saying it's gonna take time. The regulatory requirements are high, you need to put a lot of capital and you need to put a lot of resources in order to just open the door of your organization. So for me, that explains it's a scale and time matter. And I must also say that it's a very competitive market. Let's be very clear. Chinese banks are competing very hard on their market. So, you have to also enter with small margins at the same time. It's a very, very tricky question to answer also because it depends on the businesses, on the products and the services that you provide, right?
Thank you for the explanation, Eran and Alicia. The next question that we have is, for years, the fear has been that loan to state enterprises has been underprovided because of their unique role in the economy. Do you think the provisions are adequate now?
So if we're talking about provisionings, I'll take Eran and I'll give you the floor. If you're talking about provision, okay, so very, very quickly. On paper, Chinese banks, NPLs are fully covered because the coverage ratio is above 100. But as I was trying, well, what part is state-owned enterprises, which is the question, is hard to tell. We don't have that breakdown, okay? But frankly speaking, for larger banks, which tend to lend more to state-owned enterprises, their coverage ratio is even higher, which is kind of counterintuitive because we know that their probability of default is lower, which basically boils down to my point at the beginning, that bigger banks look sounder because of this, yeah? High coverage ratio and more lending to the state-owned enterprises. Now, as I was trying to say, if you actually include in the NPL ratio these special mention loans, special mention is very interesting. I even got a letter from the CBRC on this one, I have to say, explaining to me what special mention loans are, which is great because, it's not very clear. So I learned a lot. But it basically means that you note down. I mean, you note that it could be risky, but the provisioning requirement is very low, about 5%. I mean, some people here might work for Chinese banks, so they may dwell further. This means that because there is about 2 out of 1 problem loan is a special mention, not NPL, fully characterized as NPL, you can imagine that coverage ratio goes down immediately as you include the special mention loans, which means that, of course, not all NPLs are fully covered. And this might be true even for SOEs, but I wouldn't worry about SOEs too much because when you look at default ratio, it's very, very low. So I would worry for those banks where, the lending is mainly to the private sector. That's where that coverage ratio may be hitting hard. And by the way, for those banks, which are smaller banks, the coverage ratio already is much lower. That's why the CBRC, if you're following these regulatory issues, had to lower it recently because they just couldn't reach the regulatory requirement of 160. So obviously there are issues with smaller banks.
No particular comments on my side. I think it's very clear what the view of Alicia is pretty clear.
Okay, so we only have time for one last question here. And this last question is as follows. How do you see the role of Hong Kong for cross-border transactions evolving in view of the social turmoil due to the introduction of the security law?
Well, I will start first because it's a tricky question, and because I'm an economist, I can always take it and switch it. This is what we economists do. We never answer exactly. I'll do my best given the circumstances. So for those of you sitting in Singapore, I'm sure you would be delighted with a graph I could share. Believe me, I can still send it over if you're interested. It's the increase in non-resident deposits into Singapore. They're ballooning, and it's not now. So I'm not arguing this is because of this national security law, because it started in 2019. Oh, of course, things happened in 2019, as you know. So I leave it there. The point is, that I do think that, and rightly so, because Hong Kong is humongous. Hong Kong cross-border role is humongous. I don't want to offend any Singaporean here, but it's actually larger than Singapore. So basically, forget about now what's happening, which is very important. I'm not trying to downplay it, but I'm saying, if you think about the size of Asia, if you think about Hong Kong and Singapore, both of them can't absorb, frankly, a massive region which increasingly important financial linkages. So there has to be others coming, independent of what may happen to Hong Kong, which to my mind, and I just got this interview on SubChina, which I thought I was worried about, but I love the title because I fully agree. Hong Kong will change its nature, maybe more regional, maybe less international. Maybe Singapore, who was more regional, will become more international. You know what I mean? Like, they will reshape their nature. But frankly speaking, Asia is too big to be ignored. Thus, everybody will retain some kind of offshore nature. It's just unavoidable. It may change its nature. Some people may like to play with those new rules, others may not. Thus, there will be this transformation. But I don't think we can think of sudden disappearance of Hong Kong by all means, which doesn't mean that Hong Kong is not now going through relevant turbulences. But I have to remind you, the whole world is, because the next question we can't take is on the impact of COVID-19. I have to remind you that we're all going through special circumstances for different reasons, Hong Kong included. Thank you.
Alicia, I think you've been very clear. There's not much more for me to say.
So with that, this ends our Q&A session. I'd like to actually thank Eran and Alicia for taking the time out to speak on this topic. And this concludes the end of our webinar. Thank you very much to our participants as well. And please stay safe. Have a great day, everyone.
Thank you.
Bye-bye. Thank you.
Thank you, Jan, for your help. Thank you. It was great. Thank you.
Thank you.